Sounds good. Okay. Cool. All right, so let's begin. Okay, guys, so this webinar is on short selling. I was teaching, and I'm still teaching, essentially astrology for the purpose of improving your results with your investments, right? And I'm still going to do webinars where I'm going to cover those topics. However, on top of that, what needs to be understood is that just looking to make profits when the prices go up is a very, very flawed approach. It's a very, very flawed approach. It's very common and people think of investing in that way. Or let me take a step back. Most people have very, very little understanding of what it means to actually invest in the markets. And I believe, I've been working, I used to work in the financial industry. And I believe to an extent that is because the terms that are being used are intentionally confusing, intentionally deceiving, because you have an industry, and the industry is the players in the industry are motivated by self-interest, you see. So when you have an industry where the brokers have a vested interest of you losing, it means that they're gonna play a dirty game, okay? So when most people think about investing, they think about the idea of, you know, maybe hearing from someone that this and that company or this and that stock might go up. And then they buy the share of that company, and then the stock goes up 100x, 200x, and boom, they're rich. This is not how it works, okay? First of all, investing is a game of risk-reward ratios. That's really what it is. Okay, so you're not trying to find that one stock that's going to make you rich. No, what you do is you create a portfolio of uncorrelated assets. What does it mean if something is uncorrelated? It means that the markets work in cycles. There's up and down, up and down. It's a boom bust cycle. That's the nature of capitalism and financial markets. There's always an up and down, up and down. It's just what it is, right? And while some markets or some parts of the markets are going up, other parts will go down, you see? So what you want is a portfolio with uncorrelated assets, and you want to make always profits over time, okay? So your monthly performance is important, your weekly performance even can be important, but minimum, your yearly performance is important. I tell you what's going to happen if you try to get involved in the financial markets without a solid understanding of what you're actually doing. You're going to do it like most people that maybe have a 401k, you know. And what happens with a 401k? The 401k, there's no safety net there. Okay, so the 401k will go to zero most likely. You know why? What does it mean if you have a 401k? It means that you're taking part of your paycheck and it's being invested automatically for you. But if they make a wrong investment, there's nobody to be held accountable. You understand? You will lose all your money. And of course, it's a rigged game. Okay, it's a rigged game because the people that are investing the money for you don't have your best interest in heart. They have their best interest in heart. Okay. So what they're going to do is they're going to do high risk bets with your money, and high risk means there's a high likelihood that you're never going to see it again. Okay. So first of all, I believe in this day and age, there are two alternatives. Either you're going to be broke, you're going to struggle forever. Okay. Financially is what I'm saying. And yes, money is not the most important thing in life. Absolutely not. However, if you don't have an abundance of that stuff. You're really, really limited in what you're able to do. You see, so it's one of the basics that you need to cover in order to live your life the way you want it to live, in order to even explore and fulfill your potential, right? So this is one option. You're going to struggle with that topic for the rest of your life. Or the second option is you actually understand how that stuff works and you take responsibility for it. Okay, obviously I hope you have taken a second choice, which I'm assuming you have since you're here. But I just want to remind you of what's actually going on there, and it's not going to get better. We're moving into a decade, and we're moving into a decade, and we're already in that decade where things are going to be really, really harsh, really, really harsh. I mean, there's going to be somewhere around the middle, 2026, 2027. It's not just going to be a complete collapse of a financial system that we're seeing right now. Well, even the end of the American Republic, and with that, the petrodollar, and that's going to have massive, massive implications for the whole world, and not just for you guys who live in America, but the Republic as you know it right now, the United States of America, is not going to exist after that. It's going to change. How do I know it? Well, how do I know that? Well, I have information that is based on astrology, you see. So this is catastrophic for most people, and most people's livelihood is going to suffer massively, massive, absolutely. But this leads me to the next point, which is why is short selling important in that context? It's, first of all, you need a balanced portfolio. If you want to make returns consistently, always, no matter what the fuck happens, which is my philosophy when it comes to the markets, like, oh, I don't want to sit there and worry if the market's going to go up or going to go down. To me, that's retarded. Like, what the fuck are you doing? You're waiting for things to go up. You're waiting for things to go down. That's stupid. Most people are just waiting for the markets to go up, and they're always wrong with their timing. So what I'm saying is, in order to always make a profit, you have to learn how to benefit from prices going down. And that is what we call short selling. Secondly, I just told you that the next decade is going to be horrible. It's going to be horrible, which for most people is bad. Most people are going to lose everything. I guarantee it. And if you think the stock market or the markets don't have anything to do with your life, you have a lot of understanding that has not happened yet. The financial markets are extremely important for everything. That's the lifeblood of the economy. Has a real effect on everything in your life, So what I'm saying is, if the markets are going to crash in the coming decade, and you know how to short sell, my friend, this is going to be financially, this is going to be one of the best decades in your life. Probably the best decade in your life, because a cycle like that's not going to come back again. There will always be ups and downs, but not such a massive fucking crash. That's just going to happen in the next decade. So you can lay the foundation for a real empire, generational wealth, if you understand how short selling works. Now, unfortunately, nobody's fucking teaching that, right? Who out there teaches short selling? Almost nobody. But all professionals and all the people that you might have heard about in the context of financial markets are total return investors, or also called absolute return, which means they want to make a profit no matter what the market does, okay? Absolute or total return means you're always making a profit. Investors that only make money when the market goes up, or even worse, they compare themselves to the index, let's say the S&P 500, and the S&P 500 goes down 20% and they lose 15, they consider themselves winners because they have a relative performance. That's what's called relative return. We're after absolute return. If the market goes down 15%, I still want to make plus 10%. If the market goes up 5%, I still want to make plus 20. And 20 is my personal benchmark. Every year, I want to make a minimum of 20%, a minimum. All right. So, and that's doable. If you know how to short sell, 20% is absolutely doable. Okay. So let's begin with the actual content of the seminar. So let me give you the definition of short selling. The definition of short selling. We have very little, pictures today. That's gonna change in the next webinars, but for now, you don't need any. Just listen, please. Just listen and try to stay focused. Okay. So, what is the definition of short selling? Imagine there is a stock, which is a share of a company. Let's say, just as an example, let's say Amazon stock. Okay. Imagine one share of Amazon would be worth $1,000 right now. Okay. So I have done my research. I have done my my calculations, and I believe that in the next 3 months, the stock price of Amazon is going to go down. And I've also come up with a certain number. I believe that the stock's going to go down to 700. Okay. Right now it's at 1,000. So I go to a lender, somebody who owns the stock. First of all, why does the lender give me the stock? Because I go there and borrow the stock. Okay. So why does he give it to me? Now, first of all, there are institutions, professional investors and institutional investors that hold massive amounts of stocks, but they just hold them long term, but they want to make an additional profit. So what they do is they lend out stocks for a certain amount of time, and they get a certain fee for that. Okay. And the fee is usually around, I don't know, it's not a fixed price that you pay for that, but let's say it's maybe 1% of the stock price. Okay. So I go to the lender and I tell him, hey, I want to borrow 1,000 shares of Amazon. Okay. That is right now in the market, that's worth $1 million. Okay. Makes sense. 1,000 shares of Amazon times 1,000, that's 1 million. And I just borrowed that. So now I sell that right away. I sell it in the market at $1 million. I get 1 million into my account. Good. Now I'm waiting. And according to my expectations, calculations, however I came up with that, I was right. The price goes down to 700. And now I buy back those shares in the market, which costs me 700,000, correct? I give the stocks back plus the fee that I have to pay them. That's the fee for me to be able to borrow the stock, which is maybe 1% of the price, which would be whatever, let's say 100,000, which would actually be very high. Okay, but let's say it's 100,000 that I have to pay him back, or let's keep it low, 50,000. I have to pay him 50,000 as a fee. Good. Now my profit is 300,000 minus 50,000. So I made a profit of $250,000. You know, and in this example, I didn't even have to use any of my own money. Correct? Now, in reality, you still need a margin. Okay, a margin which is usually around 10% of the actual amount that you want to borrow. Okay, but those are details. But the principle should be clear. Knowing short selling and being correct with your expectation and your calculations, you can make a massive profit without even using any of your own money, because the margin stays in your account. You don't have to use it. Maybe you've heard the term margin call. Okay? Margin call basically means that you have a margin, so you need a certain percentage of the amount that you're going to borrow. And a margin call means the percentage has changed, meaning the stock price in this case would have gone up. Now I have to fill in the margin in order to match that ratio again. Okay. But that's basically what it means. This is short selling. And if you know how to short sell, you are happy when the markets crash, right? You're happy when the markets crash. Now, what's the importance of short selling in market dynamics? What's the importance of that? Why do I think short selling is great? Because a lot of people believe it's actually immoral to profit from companies crashing, because that's really what you're doing, you know? Because it might sound or look trivial, right? Oh, the stock price of this company went down. No, this has real implications. Maybe you heard of UPS. UPS recently, I think yesterday or so, increasing minimum wage, the minimum payment or the minimum salary of the workers. Okay. Why did they do that? They didn't have to, but they did that. Why? Because they did that in order to avoid a strike, because a strike would have caused packages not to be delivered, which would have decreased the stock price, and with that, the market cap, which is basically the valuation of the company, and that has real implications on many different things. Okay, so when you look at the markets in general as a whole, you have a lot of companies that are surviving on debt, if that makes sense. Okay, just like a government, for instance, which most governments do the same thing, which I'm going to explain in the context of a company, is they can't meet their basically they can't pay their bills unless they bring in debt. Okay, and it's very, you know, if you look at balance sheets and if you're good at analyzing them, you're also good at hiding the debt in some way or another. Okay, so it's not necessarily obvious that a company has too much debt. Okay, but still the company is surviving. So one of the measures or one of the ways of evaluating a company is to look at the debt to equity ratio. Okay, and if the debt to equity ratio is too high, the valuation is going to go down, right? But still, as long as there's cheap money, what is cheap money? Such as some things like quantitative easing, which is basically the printing of money, which has happened like crazy since 2008 and even crazier since the pandemic. A lot of companies are surviving on debt. They're basically, they would already be gone. They would already be bankrupt if there wasn't this free money, essentially, right? So there are a lot of zombie companies out there that shouldn't be in the markets anymore. So why is short selling important in that context? The markets are, in an ideal case, a reflection of nature. In nature, we have a process. We have competition amongst different organisms, right? The second law of biology, as Dawkins states, is competition. So it's one of the fundamental conditions in this biological system that we inhabit here, right? It's competition. So in a free market economy, different companies compete with each other. They compete based on products. They compete based on better operations, and the one that is fitter, the one that is better apt or better able to survive, is allowed to survive. So in that sense, it's a reflection of nature, right? But if you mess with the system, through cheap money, those that are not supposed to survive will survive, which is actually hurting everybody. It's hurting the consumer because they will pay too high prices. You see? It messes with the consumer and everybody suffers. Why? Because they're not getting optimal products. You understand? Because if companies are surviving on cheap money, they don't have to innovate as much. Everybody benefits, you see? Now, I understand that a lot of people, especially left-leaning individuals or people that have been raised on socialistic theories, would be abhorred hearing what I'm saying here. Well, this is all like Darwinistic bullshit, blah, blah, blah. No, everybody benefits. Everybody benefits. Because it is a competition amongst companies, everybody benefits. And you know, in an ideal world, the consumer benefits the most, because companies are now competing for your money, which means they're going to provide better services at a lower price, which is increasing the living standards of people, which increases the productivity, or rather the process forces companies to increase their productivity. And the entire living standard that we have is based on higher productivity. There's no system in any way, shape, or form that can hold a candle to capitalism. Capitalism is the absolute best system out there, because it forces companies and you know, market players to produce better and better, which allows for more and more productivity, which allows for an economy that we live in. You don't have to plant your own food. You don't have to produce it. I know there's this romantic dream out there that a lot of people think it's great. I just want to raise my own cattle. I want to grow my own food, and I want to sew my own clothes and then wash them. Okay. And what are you going to do with the rest of the 30 minutes of the day that you have left afterwards, after you've done all this shit? Do you think when people were actually doing that, they had a good life or a better life? Or do you think we have a better now, where we can just go to a supermarket, buy this stuff, do this and that and the other, because everybody's specialized, you understand? Everything in the economy is specialized, you know? So the person that is good at baking bread only bakes bread, which makes that person better at baking bread. So the quality of the bread gets better. And the same applies to everything else. This is what's called specialization. And it's only possible because we have higher productivity. We can produce more in the same amount of time, which increases the living standards, you see? So if any socialists are listening, or communists, you have no fucking clue what the fuck you're talking about. You are wishing to go back to the Middle Ages, and that, I guarantee you, was not a good life without indoor plumbing. Socialists, people that are anti-capitalist, are they think the cake is just there. It doesn't have to be produced. And now they think the only problem that we have is the cake is not distributed evenly. So they want everybody to have the same piece of cake. But what they don't understand is that humans inherently are selfish and driven by self-interest. And because we have a market where you can produce, you can work more, and you have the incentive and the perspective of getting more for yourself as a byproduct, you're actually serving the whole. It's one of the greatest things ever. Capitalism. I love it. And I think people misunderstand that. So what does that mean for short selling? And why is short selling important in that context? It's because short sellers are going out and they're finding companies which are not doing the right thing. What does that mean? See, long term, the price of the stock is always going to come back to the real value, to the inherent value of the company. Market cycles go up and down, up and down, up and down, right? And there are overvaluations and undervaluations. What you're trying to do is you're trying to find a company that is, you're trying to buy low and sell high, correct? You're trying to find a company, a share price that is undervalued, and you're trying to sell it when it is overvalued. That's basically what you're doing. But long term, there's a regression to the mean. So even if the price of the company is overvalued, sooner or later, it's going to come back to its real inherent value. So a short seller is looking for overvalued companies. We're looking for an overvalued company which means sooner or later the price is going to go down. And since the market is emotional, or the market participants are emotional, it's never going to be an even thing. It's always going to be overvaluation, undervaluation, overvaluation, undervaluation. You see? So if you find a company that's overvalued, it's not just going to go back to the real price. It's going to go below the inherent value. You see? Now, market movements are also mass movements. It's like an avalanche. You need a small thing to start the movement, and then boom, everybody jumps in. You see? So short sellers are the ones that are cleaning out the market. They're cleaning the market off out of unfit companies. Why? Because short sellers are actually looking for companies that are overvalued, and then they're the ones that are shorting the company. You can see that there are certain market screeners where you can see how many of those shares are being shorted right now. You know, you can also see who is shorting that, which is an indicator which tells you, okay, this person or this institution, they're very sharp, they know what they're doing, and they apparently believe that the company has been overvalued. So what's going to happen is more and more people are going to follow suit, and it's an avalanche. So it's going to be a flash crash. And by the way, crashes are usually two to three times faster than a bull run. Okay, and which means that through short selling you can also make money faster than by buying and holding. You see, so short sellers have a very, very important role in the markets. They clean out the stuff that is not supposed to be there. They're kind of like a vulture that smells the dead animal. Yeah, good. So what are the mechanics of short selling? I already went into the process of short selling, right? I explained that you need to borrow the stock, you need to sell the stock, you need to buy the stock back, return the stock. And I also went into the role of the brokerages, which are the ones that are, holding the stock, but it could also be a bank. Very, very rarely you have individual investors that are holding such huge amounts of stocks that you could borrow them from, right? But it's possible, if you know somebody. Margin calls, I already went into that. Now, see, another important part about short selling, this is why you need to use stop losses, of course. You need to use stop losses, because with short selling, theoretically, the only amount of money the maximum profit that you can make is 100%. Right? Because you're benefiting from the market from the price going down. So let's say the price is at 1,000 and it goes to 0. The maximum profit that you can make is 1,000 per share, because it cannot go below 0, right? So it can go from 1,000 all the way down to 0. What's the maximum potential loss that you can make? Actually, theoretically, it's infinite. Now, in reality, it's not going to be infinite, right? But it is possible that it can go. Theoretically, it's possible that the stock price goes from 1,000 to 3,000. Now if you're short selling the stock, you made a loss of 2,000 per share. You understand? So this is essentially the danger. You have a potential unlimited loss, and you can only make 100% in profit. Now, this is obviously not going to happen because you're using a stop loss, which is essentially a market order which automatically is fulfilled, and you do that as you start the trade, right? But which means basically you're gonna go through that whole process once you have lost too much, and that's something you decide upon before you start the trade. I'm willing to lose a maximum of 10% on this trade, and then automatically, as the price goes there, the broker is going to execute the trade, right? So a big loss should actually never happen unless you're like a complete amateur, right? But I have to mention it here. So So what are the factors that you consider before short selling? This essentially comes back to how to analyze a company. How do you analyze a company before you buy it? And that applies to long investments. Once again, long investments means you think that the price is going to go up. Okay. And short means you believe the price is going to go down. Now, see, the process of analyzing a company is the same whether you're going for a long investment or a short investment, which is great because you're never going to analyze a company for nothing. Why? Because after your analysis, you believe that there's a very high likelihood that the stock price is going to go up. Well, then you make a long investment. What after your analysis, you come to the conclusion, I think the likelihood of the stock going down is higher than going up. Great, now you have a short investment, you see? And that's another benefit for somebody who actually knows how to short sell. Now you have an additional approach in the market. So you're never going to do your work for nothing, right? Now, how to actually find investments, I'm going to talk about it in just a second. Yeah. So the thing that you need to look at is essentially company fundamentals. That's one of the most important things. Now, maybe you've heard of Benjamin Graham, right? Maybe you've heard of Benjamin Graham. He was the mentor of Warren Buffett, and he also wrote this very, very famous book. It's called The Intelligent Investor, okay? And in that book, he lays out the foundations of fundamental investing, okay? Investing in fundamentals. What does that mean? The theory behind that is essentially that there is an inherent and intrinsic value in a company that is determined by its, by various factors, such as its equity, its there are intangibles when it comes to that, but you can value them in some way or another, right? Such as the goodwill. Coca-Cola has a lot of intangibles, right? It's the brand. How do you value a brand? Very hard to do, right? But it's undeniable that soda brand No Name and Coca-Cola have a different value based on this intangible brand, right? But so you have to find a way to put that into your calculation. So Coca-Cola is worth more, right? But for the most part, you will go by equity, you will go by inventory, you will go by market share, economic moat. Once again, that's a little bit harder to value. But there are various factors that you look at, and those are called fundamentals. And at the end of your analysis, you will come up with a price. Okay, this is a price. It also depends on what industry it's in, right? Because different industries have different multiples that you have to multiply the EBITDA with. EBITDA is essentially the profit before taxes, right? And then you will come up with a valuation. All right. Now, the share price, meaning the stock price of the company, is never 100% reflect your valuation. Why? Remember what I said earlier. It's overvaluation, undervaluation, overvaluation, undervaluation. Why? Because market participants are human beings, which means they're emotional. So they will follow suit. It's like mass psychology. People have a very, very hard time to be contrarian. Most people want to do what most other people do because they don't want to feel like they're taking a risk. See, this is also why if you can deal with being contrarian, if you can deal with having your own theory and following your own theory, you have a massive advantage, right? So personality also plays a role, right? But what I'm saying is fundamental investing essentially means that here's the stock price, or sorry, here's the intrinsic value in the company. The stock price is going to go there and here and here and here. It's always going to go above and below, overvaluation, undervaluation. However, long term, what Benjamin Graham essentially says, or the theory of fundamental investing essentially means that the stock price is always going to come back. It's going to go up and it's going to go down, but it's always going to come back to the intrinsic value in the company. All right. And based on that, we can say if it's a long or short investment. Now, obviously, I'm giving you the rough outline here. There are many more technical details that you have to consider, but it's enough. It's sufficient for you to understand what I'm saying here. So fundamentals are important because of that, because the price always comes back to the fundamental, to the intrinsic value, which is based on the fundamentals. Okay. Now, a very, very important part is also the risk-reward ratio. And if you use the risk-reward ratio based on historical performance, you can come up with a mathematical ratio. What is the possibility, or what is the probability of the price going up versus price going down? And based on that, you will come up with a certain ratio. Let's say, for example, 3 to 1. 3 to 1 in this case would mean that the price is going to go up with the probability of 3 to 1. Okay. And if you only make investments where the probability or the risk reward ratio is in your favor, and you make, let's say, 300 bets, it's like roulette, right? You make 300 bets, and let's say the ratio of red versus black is 3 times higher. Over 300 bets, you will always win. You understand? Because you're now, even if you bet on red, there's still a 1 in 4 possibility that it's going to be black, right? However, over the long run, you're always going to win if we have this unusual roulette table where the probability for red is 3 times higher than for black, right? Now, obviously, on a normal roulette table, it's 1 to 1, right? But I'm talking about an example here. Yeah. So these are things that you take into consideration. Then we have, of course, market trends. Okay, what are market trends? How are market trends affecting where the prices go? Now, that's a topic in itself. That's an entire webinar in itself, right? But we can generally say that you have to understand, and it's really not rocket science. It's really actually kind of intuitive, right? Imagine, let's come back to Amazon. So let's say the CEO of Amazon is going through a divorce. His wife filed for a divorce. How do you think that's going to affect the stock price? Imagine the CEO himself. He's a fucking robot. He doesn't even give a fuck. He's happy that she's divorcing him, right? So his performance is not going to be affected individually, which is very unlikely. Let's for the sake of this argument, let's imagine he keeps performing like he performed before, no change. But the people hearing that are going to expect him to perform differently. So that's going to affect the stock price. How? Most likely negatively, because people are going to go, people are going to sell the stock, right? So this is one example. Now, obviously, there are astrological factors as well, but you want to use the astrology as an additional tool, specifically in your technical analysis. Okay. Then, the impact of interest rates and dividends. Impact of interest rates and dividends. How is that going to affect short selling? Well, for the most part, see, when let's go to the first example that I gave you. You hold Amazon stocks, and Amazon, during that period of time when you're holding the stock, pays dividends. The dividends are going to come out of your pocket. You have to understand that. The lender is not going to pay the dividends. You're going to pay that. That might be a consideration. That might, there might be something that you have to take into account depending on how many stocks you have and depending on how high the dividends are, right? And of course, also depending on your trade volume, right? So yeah, identifying potential short selling candidates. So we already talked about that. I have my list of points here. Timing the market. You never time the market. You can't time the market. Nobody does that. But the closest thing to timing the market, in my opinion, is astrology, astrological factors. Okay, so the way you work in the stock market is the following thing. The first thing that you do is you're not looking for a stock. You're not looking for an asset even. You understand? Stocks, derivatives, asset classes, they're all just tools. They're all just tools to make a fucking profit. What you do in the beginning is you approach the whole thing with a specific strategy. So what you do is basically you say, okay, I'm going to use the George Soros approach or the Benjamin Graham approach, right? And each of those approaches, each of those investment philosophies value and analyze stocks based on different factors, right? So in the case of, like I said, the Benjamin Graham approach, the PE ratio, for instance, is very important, and many multiple other factors. You know, book to earnings ratio and all these things, right? Now, knowing what you're looking for right now, and each of those have a specific range that you want to have, right? Each of those PE ratio should be a certain way. Price to book ratio should be a certain way. Price to book value, sorry, should be a certain way. Now, with that, you put those values into a market screener. The market screener is then going to show you maybe 5 different stocks that match the ratios that you wanted, right? Now you have a list of 5 stocks, and those 5 stocks now you analyze in more depth, right? So now you look at the fundamentals. You gather some more information about what the company's doing. You look at news about that company. You look at the market environment in general. You know, the industry that they're in. Maybe it's a fucking AI company or AI. What is happening in AI right now? Sam Cook or whatever. That's crypto, right? Sorry, yeah, Sam Altman. Anyways, so what you're doing is you're basically doing your research, right? This is why I don't like this image that's being put out there. You know, most people's idea of somebody who's doing things in the markets is essentially, oh, they're just sitting in front of the screen. They're just trying to, you know, take advantage of minute little. This is bullshit. This is scalping, and bro, you're not going to be able to compete with high frequency trading out there. Okay. Because what these people are actually trying to do is they're trying to compete with algo trading, which is done by artificial intelligence. No matter how smart you are, about how fast you are, you're not going to be able to compete with a machine that is trading 1 million times per second. Okay, what they do is basically the institutions, usually hedge funds, with the capabilities of doing algo trading. What they tell the machine is essentially, I want the price to be at X at this time. And the computer then goes about and sells and buys shares 1 million times per second, so that the price matches exactly where they want it to be at this point in time. So what are you going to do now? That's bullshit. Okay. So there is still a way to make money in the markets, but in order to do that, you have to do what I'm telling you right now. You have to do solid research. You have to understand what the fuck you're doing. There's one principle when it comes to money. Okay, if you've been on my Money Magic course, I talked about the principle of money equals control. The more you control the investment, the more money you're going to make with it, or the more profit you're going to make with it. Right? So what is the equivalent of control in this context? It's knowledge, solid research, better understanding. Yes, you have hedge funds and high frequency traders that can manipulate the markets. However, certain principles cannot be broken, such as regression to the mean, such as certain astrological factors, such as certain market dynamics, such as flash crashes, such as human psychology is still very relevant. So, basically cognitive biases. These factors are not broken. So you got to understand those, and based on that, you will increase your control over the investment, you see? But that takes an understanding. Okay, this is what I'm saying here. I don't like that image of a person just sitting in front of a screen and waiting for things to go up. People like that don't make money. That's bullshit. That's a urban myth. Okay, so good. Let's come back to what I was mentioning. Yeah. So you have the market screener giving you, let's say, 5 different stocks. Now you go deeper and you analyze the company for this and that and the other, right? And now you will also have done some technical analysis. Okay, technical analysis basically means you look at the historical performance through the chart, and that's a little bit more mathematical, right? And let's say at the end of it, you come to the conclusion that this company is a complete trash, bullshit. It's bad. And if your thesis is solid, now you're going to start short selling it, and you're going to go through the process that I mentioned earlier. Okay. You don't necessarily time the market. Not yet. What you're going to do is you're going to look then, after you've done all of that, you're going to look at astrological factors. And each company has a birth chart. Okay. How do you know the birth time and the place? There's something called an initial public offering. If it is publicly traded in the US, it's usually going to be New York, at a certain time of the day, usually in the morning. And now you have a birth chart. And a birth chart is going to be affected, just like a person is going to be affected by certain astrological factors. The company is also going to be affected by certain astrological factors. Okay. So you now have an additional indicator of when the stock is going to go down. Okay. And then you're going to use that. Now you know, okay, I can hold it until after this astrological alignment. And that's going to inform your decision. It's the additional edge that you're going to get through astrology. Okay. And make no mistake, it is a massive. If you listen, when you go deeper with me into this journey of financial astrology, which I hope you will do, I can show you millions and millions and millions of different examples where the big players are moving the markets. Yes, they're manipulated, but they're moving the markets in alignment with those astrological factors. Now, there are 2 options here. Either they themselves are subject to these astrological factors, which they are, but what is actually happening in reality is that they see the whole world as one big ritual. Even wars, even all of these things are part of an esoteric agenda, and they're just playing out a ritual. That's basically how they see the world, And so they follow these things as well. They follow astrology, and you can have the same edge if you understand it. Okay, so what are other short strategies? Well, you can use essentially options to hedge your portfolio. Okay, there will always be a certain probability that the stock's not going to do what you want. So you can hedge your risks using options, for instance. An option is something that allows you to buy a certain asset at a specific price that is agreed upon before, but you don't have the obligation to execute that, but you can, and it costs you a fraction of what the actual asset is worth, but it is a hedge because you can basically lock in a specific price that will save you a lot of money once the bet goes wrong, right? Futures can also be used for that, but futures actually include an obligation. So you have to sell the future before it comes to term, okay? Now, I can't, listen, on this webinar, I can't go into all of this stuff, and also the attention span is not gonna be there, right? So let me just go through a couple more points, okay? And then we go into a Q&A. So what are legal and ethical considerations? It's absolutely legal in any more or less free country. If you live in the United States, if you live in Europe, if you live in Asia, if you live in Africa, if you live in most countries, it's absolutely legal to short sell as long as you got access to a financial market. Now, in the most capitalist country in the world, right, the US, which is kind of ironic, contracts for difference, CFDs, are actually illegal. They're still legal outside of the US, you know, which is kind of funny. But after 2008, with all that shit that was going on, they made them legal, right? Ethical issues in short selling. Well, that's up to you. I told you my philosophy. I think short sellers actually play a very, very important role in the markets. They clean house, you know. They clean house, but some people have a problem, an ethical problem with benefiting from a company going down. But I believe personally, you know, I mean, respect if somebody is very, very ethical. I try to be ethical myself, but I think, you know, it's based on a wrong understanding or an incomplete understanding of what's actually going on. What is the impact on companies and markets? Well, you can absolutely completely destroy a market, a company, even a country short selling it. You know, I mean, there's George, I don't know if you heard of George Soros before, but George Soros went down in history as the man that broke the Bank of England. He short sold the British pound and cost and almost, you know, destroyed the entire currency, which would have destroyed the British economy, for, you know. So if you're good at what you're doing, you can absolutely have a massive influence, positive and negative, on many factors, you know. And that trade single-handedly probably destroyed millions of jobs, you know. So it's very impactful, it's very powerful, and you have to be okay with that. Now, I'm not saying that you're George Soros or that you're gonna break the Bank of England or any country for that matter, but that's a potential impact. You just have to be big enough. And if you're a hedge fund, that might very well be the case, you know. You can also destroy a company. If it's just a company and you're short selling it, you can definitely make it go down, you know. And a lot of companies try to sue short sellers, not individual retail investors. So you're not in, you're probably most likely not going to be sued by a company if you short sell it. But if it's an outspoken investor, somebody that's well known, somebody that runs a hedge fund or whatever, they run the risk of getting sued by the company. Because think about it, if you're essentially saying, okay, I'm short selling their company, but what you're essentially saying is, I don't trust their numbers, I don't trust them. And that could be very, very devastating for business, you know. It's like, yeah, I think you get the idea. Good. So this is a rough outline of what short selling is. Listen, I'm going to do multiple webinars where I'm going to talk about more and more of that stuff, right? To give you more and more of an insight, and also on how to use astrology, of course, to get better at this. But it's always better to keep it keep it short and sweet. I mean, this was already a lot of content, and I don't want to overwhelm you. And just watch the next one. Just be on the next webinar. Good. Let's go into the Q&A. Please just unmute yourself. There's no real rule here. Just unmute yourself and ask a question. I'm going to do my best to give you a good answer.
Hey, Frank. So I'm wondering if there is a way that I can use this financial astrology for trading currencies. Like, I know a little bit about Chinese astrology. So I'm thinking if there's a way of using, like, let's say it's the United States dollar against maybe the South African rand. Like, is there a way that we can use some days where those countries were found, or maybe they go strong or something, and we can play them against each other?
Yes. But in that sense, the currency is a reflection of the company. So I would go for analyzing the economy as a whole of the company. Okay, so once again, you're still going to have to look at fundamentals, and please mute yourself. You're going to have to still look at fundamentals and other factors. But then once you have done your analysis, please mute yourself. Once you have done your analysis, you will then, in addition, look at the birth charts of the different countries and see how they're going to be affected during the time frame that you're choosing to trade in. And you will see that the currencies, or the ratio, or the relationship between the currencies is going to reflect the astrological factors. I hope I'm making sense here. Okay, so you said I think US dollar versus South African rand. So let's say the US dollar, I don't know what the ratio is exactly, but you're making money on the fluctuation. And if you see that the US birth chart is going to be affected negatively during this day, and the South African birth chart is going to have a good day, you can pretty much count on the currencies reflecting that too. Okay, next question, please.
Hey, Frank, I was curious, is there anywhere we can practice short selling or any stock trading online for fun without money involved, or is it something that we just get involved with, practice with money? Maybe just like
no, there are. I mean, you need a you need a broker with a margin account. That's important. Not all of them have that, and if you don't want to do that with money, you would have to find one with a demo account. Now, off the top of my head, I can't tell you one that has both of them: a demo account and a margin account. I don't know if. I mean, you would, but I mean, if you do a little bit of research, I'm sure you're going to find that you need a demo account and a margin account. A broker with both of those functions. And listen, guys, if you know how to short sell, this is your decade. You're going to be filthy rich. Why? Because everybody's going to suffer. This fucking economy, like, mark my words, 2026, 2027. If you are not prepared, bro, you're like, you know how many existences are going to evaporate? Everything, man. I don't care what you have. I don't care. I have a house. I have this. I have some real estate. Get out of here, man. It's done. It's all done. The giant will fall. The US, as we know, is not going to exist anymore. The US dollar is going to be over. 2026, 2027. There's a 120-year cycle that is coming to a conclusion in 2026, 2027. And it's bad. It's all, yeah. But like I said, if you're knowing what you're doing, if you know what you're doing, this is going to be the best ticket ever. You know that all the dynasties that we hear about, all the dynasties that we talk about, they all had their foundation, or their foundation laid, or a lot of them had their foundation laid during the Great Depression or after. That's where the money's made. Cool. Yeah.
Hey Frank,
Yeah.
so I got a question. Let's say, like, I'm interested in this financial astrology, but then I need some guidance. I could really use some guidance. If I want to do some kind of research on my own before I can jump like into your stuff, because right now I'm kind of, in between making, I'm kind of like in between attracting my financial abundance. I'm not like yet stable to buy your courses and stuff. So is there any way, any book that you can recommend me so that I can like get at least a glimpse of what
That's a
this
problem.
can like?
That's really a problem. I would tell you really if I knew. But the problem is that I don't know a book that is conclusive and even in depth when it comes to short selling. I really don't. I really don't. So that would be my problem. Maybe I don't know. But I mean, you will find things about short selling here and there, but there's not one resource that I can tell you. Really.
Thank you, brother.
Yeah, no problem. Yeah, I hear a lot of things. I get messages a lot from different countries, and the thing is, like they I think what a lot of you guys forget is that if you live in certain places, you also have much lower living costs. So if you make 3 grand, that goes a long way. If you make 2-3 grand in the US or Europe, that's not a lot of money. But if you make that kind of money, which is very easy, hold on one second. Yeah, I'm doing the seminar right now. I'll call you later. Right? Yeah. Yeah. So that's like 30. That's like making 30,000 over here, which is okay, which is a decent amount. So I think it's all about perspective. Also, yeah, I mean, that's what I would focus on. Like financial abundance is always a relative thing. It's always a relative thing. Do we have more questions? No more questions? No more questions. Okay, so Wasi, do we have the replay of the second webinar available? I think it is available, right? Should be, because somebody asked the question if I can send out the replay of the last webinar. Yes, I should. Yeah, okay, good. Yeah, so I'll send out the replays of the last one and this one in 2 separate emails. Good. Okay, folks, I hope you got something out of this. So watch out for the next one. We're going to go into more depth. Now, first of all, what did that do for your understanding? I want to get a feedback. What do you think I could have done better? What did you get out of it? What did you not get out of it? Anyone who wants to share? Thank you. Okay.
It definitely gave me more of a understanding and overstanding of what shorting a company is, because I've been hearing these terms a lot as I've been, investigating how to invest, both in stocks, and I'm looking at crypto now too. So, it definitely gave me more of a insight into that. I appreciate that. Thanks, Frank.
No problem. Great. Okay. All right. Okay. So wait for the next one. Peace. Bye-bye.